everyone, and in this video we are going to talk about learning objectives 4.3 and 4.4 and 4.5. We're in learning how to compute Social Security and medical tax withholding. Now, Social Security tax is withheld from all employees, which is mandated by the Social Security Act of 1935, covered in Chapter 1. This is applied to all gross wages. The amount that is withheld from your payroll checks is at 6.2%, which is withheld from the employee's payroll check, and it is matched by the employer until the employee reaches the wage base, which is the maximum amount of salary for Social Security taxation. Now, in 2015, the Social Security tax wage base is $118,500. This amount does sometimes change from year to year, so it is good to check the IRS guidelines to make sure that threshold has not changed. This is covered on page 123 and 124 in your book. Now, some examples in order to how to calculate this. One thing to keep in mind is that the employer must know the year-to-date salary at the end of the previous pay period. So, for example, if you look at employee number 2, year to date they've earned $90,000. So they're still underneath that threshold of $118,500. So the full employee period wages of $2,850 is taxable for Social Security at 6.2%. So 6.2% multiplied by the period wages, the Social Security tax withheld is $176.70. That comes off the employee payroll check, and the employer, remember, must match that. For employee number 3, as you notice, their year-to-date salary at the previous pay period is $112,600. Remember, the threshold is $118,500. So $118,500 minus $112,600, the difference is $4,400. So that is the amount that's going to be taxed on the employee's payroll tax at 6.2%. So the amount of Social Security withheld is $365.80. Employee number 4, as you notice, the year-to-date salary is $118,000. Remember, the threshold is $118,500. So only $500 of the employee's wages will be taxed at 6.2% in the amount of $31. Employee number 5, they are way beyond the Social Security tax wage base amount, so they will have no Social Security tax withheld off their payroll check. One thing I will mention again is that whatever the employee pays in Social Security tax, the employer must match. The other taxes withheld, the other FICA tax is Medicare tax. Employers must also withhold this from the employee's gross pay. The percentage for Medicare tax is 1.45. That is withheld, and it is matched by the employer. Now, there is no wage cap for Medicare tax. The only difference is that there's an additional 0.9% tax applies to only employees who earn more than $200,000. On the additional 0.9%, the employer does not match that. So let's take a look at some examples. As you notice, there is no limit on Medicare tax. So employees 1, 2, 3, and 4 are way under, as you know, the $200,000 for that extra Medicare 0.9%. So basically, you would take your period wages, multiply by 1.45. In this case, would be $24.65. And what they're doing there, and they're showing the employee and the employer amount, so it'd be $49.30 total. Now, on employee number 5, as you notice, they already have earned $195,000. Remember, for Medicare, if you're over the $200,000, you are going to have to pay that extra percentage. So the employee would pay $10,000, multiply it by 1.45. In this case, they're going to take $5,500, multiply it by 2.35%. The employee and the employer's total Medicare then would be $354. Okay, and this is covered on page 124 in your book. Now, learning objective number 4 does cover state and local income taxes. Many states levy income taxes, and the list of states is located in Appendix D in your book. And some local cities and states, okay, Appendix B starts on page 316 in your book. Some localities also withhold income taxes. New York City residents, for example, withhold 4.25% tax. Denver, for example, does 5.75 tax per month for employees who earn more than $500. And then Maryland is at 3.2%. Multi-state and local employers must be aware of the applicable taxes. So it does vary from state to state, so please keep that in mind. It is covered just on page 125 in your book. All right, learning objective number 5. This is post-tax deductions. These are court order garnishments that come off your payroll check, which is post-tax, so it's after taxes. Some deductions, some examples is child support, consumer debt, and any non-tax debts owed to federal agencies. There could be possible union dues, which the employers pay union dues for the employees as a non-cash employee compensation. And this is covered on page 126 and 127 in your book. All right, on consumer credit, this would be like for credit card garnishes may not be more than 25% of the employee's disposable earnings, or the amount by which the employee's disposable earnings are greater than 30 times the federal minimum wage, which is $217.50. The reason why they do put a limit on there, they want to be sure that employees do have enough money in their checkbook to cover their daily living expenses. In child support, it may be up to 50% of disposable income, an additional 5% for any child support that is more than 12 weeks in arrears. And then non-tax debt owed to federal agencies, not more than 15% of disposable income. Just keep that in mind. They want to be sure that employees, like I mentioned, have enough money in their checkbook in order to meet their daily needs for their families. Some post-voluntary deductions that employees can participate in could be charitable contributions, additional tax withholdings, savings bonds, college saving plans, long-term care plans, maybe health care deduction or health club deductions, and all deductions must be listed on your pay stub in order to have each employee aware what is being deducted off their payroll checks. Okay, and that is covered on page 127 in your book. All right, moving along. Learning objective number 6. This is analyzing the employee's net pay. All right, so how do we calculate the employee's net pay? The first thing that we have to do is that step 1 is to calculate the employee's payroll gross pay. All right, we need to calculate their gross pay. The second step then is subtract any pre-tax deductions to get the total taxable earnings. Remember, the pre-tax deductions could be your 401k, health insurance, life insurance, short-term, long-term disabilities. And then we need to compute the taxes to be withheld from the total taxable earnings. Step 4, we're going to deduct the taxes from the gross pay. Step 5, we're going to deduct any other voluntary or mandated deductions. And then step 6, it results in the employee's net pay. So an example of that in regards to Mr. Smith, as you notice, we have his regular and overtime earnings, $480 and $36. Okay, and this is covered on page 128 in your book. His federal withholdings and then Social Security withholdings, and then Medicare withholdings. His pre-tax insurance is $50, 401k is $25, The union dues is 31, state withholdings 36, and garnishments. So his total deductions is $202.25. His net pay then in regards to that would be $313.75. As you remember from the readings, pre-tax insurance is 50, 401k is 25. That comes out pre-taxed. Once this is taken off, you get your taxable income, and then you calculate your federal withholdings, Social Security, Medicare, union dues, state withholdings, and garnishments. Okay, and this is covered, like I mentioned, on page 128 in your book. Some notes to remember. Social Security and Medicare amounts are computed on gross pay, less qualified insurance deductions. So that is, keep that in mind. So you get your gross pay, take out your qualified insurance deductions, then your Social Security and Medicare tax amounts are calculated. Federal and applicable state and local taxes are computed using your taxable income. And the taxable income is gross pay less your pre-tax deductions. All right, learning objective number 7. This is the last learning objective of the book, or in this chapter. Some ways that employees can get paid. They can get paid in cash. It's not commonly used just because there's no record of what is being deducted off the payroll check. It does pose a risk for employers due to tracing of all the deductions along with the pay, and can be transferred rapidly among people. Some popular methods is traceable, secure, and simple. Problems, it's easy for the owner to commingle funds, account reconciliation, and employees' checks may remain outstanding. The ways employees can get paid is check, which is the best practice by employers because it separates business and payroll checking accounts. There's records of each check used, disposition of payroll checks, cashed and uncashed, in order to do some reconciliations on payroll. The way employees can get paid is direct deposit. It is the method that is preferred because it's paid directly into their accounts. This avoids paper for the employer and payroll processing time waste. Can be problematic, unfortunately, if the employee does not have a bank account. It is the best practice. Employees can trace their checks into the internet portal to access their pay records. It links the payroll records with human resource records, and also there's multiple identity verification levels. It is more secure for the employer and the employee. Pay cards isn't used too often, but they can be used. These are debit cards to transmit employee pay. The advantages bypasses the need for employee to have a bank account, and its convenience for the employees to use. Some of the disadvantages, of course, it can be lost, or it can be theft, may experience withdrawal limits or other use for problems. It's not protected by like a checking account by your bank. Okay, and this is covered on page 130 through page 133 in your book. Some best practices also allow employees to monitor pay cards to their balances secured via internet portal. Payroll software that the employer uses is designed to encrypt funds transmission and enhance securities. Employers must match the employee's contribution for Social Security and Medicare taxes, so it's nice to make sure there's security there. Some other mandatory deductions include garnishments, child support, and non-tax federal obligations. Remember, it's gross pay less deductions equals the net pay for the employee. All right, so if you do have any questions in regards to Chapter 4 on the PowerPoint presentation, please let me know. I will be reviewing upcoming videos on the Chapter 4A exercises. If you do have any questions, please reach out to myself.